Hi there, Eric here with Portfolio 24. In this video, I'm going to make a very brief presentation of what options are. This is really a beginner's video. Hopefully, this will help you. My take on options is that if you're a beginner, just keep it simple. Remember that there are two types of options. There are calls and there are puts. Keep it simple. There are so many fanciful words there. You have strangles, you have butterflies, you have credit days, and all that. I would not even focus on that. Just keep it simple if you're a beginner. So first of all, if you like our video, please remember to smash the like button and subscribe to our channel. Share this video. This makes our channel more popular and encourages us to produce many more videos. I have to start with a disclaimer. This video is for educational purposes only. Options trading is very risky and not suitable for everyone. You may lose all of your money. So what is a stock option? A stock option is like a coupon with an expiration date. So when you have that coupon, it gives you, the option buyer, the right but not the privilege to buy a stock. Just imagine yourself that you have a coupon from a store like Costco or Walgreens or any store like that. That coupon gives you the right to buy a certain product at a certain price, but you don't have to go to that store, so you're not obliged to go buy. However, the store has an obligation to sell that product to you if you present to the store with your coupon before the expiration date that is on that coupon. So that's pretty much what an option is. An option has a set price, which they call a strike price. It has a set date, this is the expiration date. In the United States, one options contract is 100 shares. And remember that options are derivatives of financial securities. So an option, if you hold an option on a stock, let's say you hold an option on Facebook, it does not mean that you own Facebook stock, but you own the option. You have the coupon that gives you the right to buy Facebook stock at a particular price before a particular date. If that date comes by and you don't buy it, that option expires worthless. So you have to remember that. Stock option sellers have the obligation to sell. So if you decide one day to become a stock option seller, remember that when you sell that option, you need to have the stock so that you can, if the option buyer shows up and wants to exercise that option, then you have to sell it. So you have to remember that. So there are basically two types of options. You have a call option, which you can either be the buyer or the seller, and you have a put option, in which case you can be the buyer or the seller. That's it about options. Sometimes people combine them. You have puts and calls to create different strategies that have some very fanciful names. But as a beginner, keep it simple. Keep it stupidly simple. A call option gives you the right to buy a stock at a particular price, and a put option gives you the right to buy a stock at a particular price. So let's go into more detail about a call option. With a call option, the buyer is betting that the stock price is going to go up. So that's when you buy a call option. Let's say if I want to buy Facebook stock, Facebook is now trading at $200 on January 1st. I believe that Facebook is going to be trading at $220 on January 31st. I could decide to buy a call option with a strike price of $210. So if Facebook goes beyond $210, I'm already making a profit because I can buy the stock for $210, which is lower than the current price of Facebook. So if the current price of Facebook is $220 and I buy the stock for $210, I already have a $10 profit. That's $10 profit per share times 100. That would be $1,000 profit. So that's how call options work. So when this is the screenshot from RobinHood. This is like an aftermarket screenshot So when you go to Robinhood, you have to pay close attention. I'm using Robinhood because many beginners, they use Robinhood too. It's not the best platform. There are so many other platforms like tdameritrade, you have E-Trade, you have Schwab. They are all very good. I think they are much better platforms than Robinhood, but a lot of beginners use Robinhood, so I have to introduce you here to Robinhood. For you to be able to trade options, you have to apply for that privilege or that right to trade options on any one of the platforms. So remember that you have to identify what you're buying. In this case, it's a Facebook call option. There is an expiration date, there is a strike price, and always look at the current price of the stock. So let's talk about the put option. In the case of a put option, you, the buyer, you are betting that the stock price is going to drop. So if the stock price drops, you're going to make money. So let's take Facebook again. On January 1st, Facebook is trading at $220. You believe that Facebook is going to drop down to $180 by January 31st. So now you may decide to buy a put option. So you decide to buy a $190 put. If before the expiration date or by the expiration date, if Facebook stock drops down to $180 and you do have a put option with a strike price of $190, it means that you can buy the stock for the current price $180 and turn around and sell it to the guy who sold you the put option for $190, and then you make a $10 profit. That's how you make money with a put option. It's pretty simple. Once again, when you want to buy the option, you have to pay attention to all the different pieces of information: the expiration date, the strike price, and of course you look at the current price of the stock, and also the price of your put option. This 1.39 is for one stock. Remember that one contract contains 100 shares. So the total price for this $129 put option on this Walmart option chain is going for $139. That's how much you're going to pay for this option. So how are options priced? Option contracts are priced using very complex mathematical models. That's the more reason why today on Wall Street, the people who get employment on Wall Street are mathematicians and physicists and some psychologists. If you do your banking and finance, you may not even get a good job there. The mathematicians, they get the best jobs there. So the options price depends on the current stock price, on the strike price, the intrinsic value. What is the intrinsic value? The intrinsic value is the options in the moneyness. The call option intrinsic value is equal to the current stock price minus the strike price. So if you look at the case of Facebook, for example, you bought a Facebook. Remember, we bought a Facebook call option. We bought a 190 call option. Now, if Facebook is going for $200, if we decide to sell that option, it now has an intrinsic value of about $10. That's the difference. So that's the intrinsic value right there. The option price also depends on the time to expiration. So you have an option that is expiring within a week, it's going to be much cheaper than an option that expires within a month. And as a beginner, remember this is just for educational purposes only, but as a beginner, I would probably not buy an option that expires within a week or two. I want to give myself some more time because you can lose a lot of money with that. It also depends on the market volatility, which means that if the market is going up and down, if the Dow is up 500 points today, tomorrow is down 300 points, there's a lot of volatility in the market. So the option prices are going to be higher when you have high volatility. So I hope this video gave you a very brief introduction to what options are. I'm going to put up another video which goes into more detail about the option Greeks and some very simple strategies which are helpful